What if I told you that one of the biggest stories in tech, one that's fueled NVIDIA's astronomical rise, might be about to get derailed by geopolitics? Is NVIDIA's AI dominance facing a truly shocking challenge from a familiar adversary? All right, buckle up, investors, because the news we're diving into today is a big one for NVIDIA, ticker NVDA. China's State Administration for Market Regulation, or SAM, has just announced they're launching a full-blown investigation into NVIDIA for suspected violations of their anti-monopoly laws. This isn't just a preliminary sniff around. SAM says their initial probe actually found NVIDIA broke the law. The probe zeroes in on NVIDIA's 2019 acquisition of Mellanox Technologies. China conditionally approved that $6.9 billion deal back in 2020, and now they're checking if NVIDIA actually kept their promises. Now, this isn't happening in a vacuum. It follows a U.S. Justice Department probe into NVIDIA's chip dominance, and many analysts see China's move as a direct response, a retaliatory shot against recent U.S. curbs on China's semiconductor industry. And how did the market react? NVIDIA shares immediately tumbled by around 2.6% on the news. So, who exactly are we talking about here? NVIDIA, headquartered in Santa Clara, California, is a global powerhouse in graphics, compute, and networking solutions. They're the brains behind your GeForce gaming GPUs, the backbone for enterprise workstation graphics, and the silent giants enabling AI and high-performance computing in data centers worldwide. Financially, they're a beast. Fiscal year 2025 revenue hit an astonishing $130.5 billion, a 114% jump from the previous year, and their three-year revenue growth is a mind-boggling 383%. For Q2 2026 alone, they pulled in $46.74 billion in revenue. Looking ahead, analysts forecast EPS to grow almost 50% in FY 2026 to 4.45 per share. Their main moneymaker is the data center segment, bringing in $115.19 billion, a dominant 88.27% of their total revenue. Gaming comes in second at $11.35 billion. Geographically, the U.S. is their largest market at $61.26 billion, followed by Singapore at $23.68 billion, Taiwan at $20.57 billion, and then China, which contributes a significant $17.11 billion to their top line. With gross margins at nearly 70% and operating margins above 58%, this company is a profit-generating machine. Now, let's connect this China probe to NVIDIA's bottom line. This isn't just noise, it could hit them where it hurts. The investigation into the Mellanox acquisition and general antitrust concerns in China could severely restrict NVIDIA's access to what is currently their second-largest market. So, how do we get to that number? First, we have to look at how much NVIDIA makes from China. It's about 13.11% of their total annual revenue, making it their second-largest market after the U.S. This news specifically targets their sales there. Given this adverse regulatory finding and continued probe, we're estimating a 20% revenue decline specifically from China for the upcoming quarter. This reflects increased hurdles, customer hesitation, and potential market access limitations. Now, to understand the total impact, we take that 20% hit to China revenue, which translates to about a 2.62% drop in NVIDIA's overall quarterly revenue. Here's the key part: operating leverage. NVIDIA has high fixed costs from all that massive R&D into cutting-edge chips and maintaining their fabrication-less model. So, for every 1% change in revenue, their operating income changes by a larger percentage. We're estimating an operating leverage multiplier of 2.0x. So that 2.62% overall revenue hit multiplied by our 2.0x operating leverage gets us to a 5.24% hit to their total earnings. What does that mean for your shares? Well, based on their forecasted annual EPS of $4.45 for FY 2026, this translates to roughly a negative 23-cent impact on their annual EPS. That's significant. We're calling this our moderate impact scenario, and we assign a 60% probability to it. In a low-impact scenario, we might see just a 5-cent hit, but a high-impact scenario with more severe restrictions or fines could push that EPS impact closer to negative 47 cents. Now, the market's reaction? NVIDIA shares fell around 2.5% to 2.6% immediately after this news broke today. This tells us investors are already starting to price in this increased regulatory risk and the potential financial implications for NVIDIA's massive Chinese operations. So, what's the final verdict on this news for NVIDIA? This is unambiguously bad news. The preliminary finding of an anti-monopoly law violation by China, combined with the ongoing investigation, introduces significant uncertainty and risk. With China being such a crucial revenue source, any meaningful restrictions or prolonged regulatory hurdles could definitely cool NVIDIA's red-hot growth trajectory and impact its bottom line. This adds a substantial geopolitical headwind to a company that, by all other accounts, has been firing on all cylinders. For my personal take, given NVIDIA's incredible growth story and market dominance, but now facing this escalating geopolitical and regulatory risk in a key market like China, I'm putting NVIDIA on a hold for now. While the long-term AI thesis remains strong, I need to see how this China situation plays out. It's too big to ignore. Monitor closely for any further developments or clarity from SAMR. That's all for Ticker Shock today. If you found this insightful, hit that like button, subscribe to the channel, and ring the notification bell so you don't miss our next deep dive. And remember, this isn't financial advice. It's for educational purposes only. Always do your own research before making any investment decisions. I'm Dave, and I'll see you next time on Ticker Shock.